Good afternoon, everyone, and welcome to the first ever nightly game plan session. How is the sound? Can you hear me? Am I coming through loud and clear, hopefully? Great. All right, good. Hey, guys. Hey, Jennifer. Hi, everybody. Good to have you all, as always. And welcome, welcome. Most of you know me, but for those that don't or are new to T3, my name is Sami Abu Saad. I'm Director of Education at T3Live.com and lead moderator of the Black Room. That's what I do. I'm a trader just like a lot of you, except that I'm an active day and swing trader. Every day I have several positions on, whether they're day trades, swing trades. The day trades are done in the Black Room. The swing trades will be done in here. Let me give you some information about the program, the nightly game plan program. First, in the first few sessions, we're going to cover the course manual, which you can access from your customer portal at t3live.com. Just please make sure you're using Google Chrome as your default internet browser. All the sessions are going to be recorded and archived, so if you are not able to join us live, you can always watch them later. And once we're done going over the manual, we'll move on to phase 2 of this program, which is going to be about the nightly preparation. And that's truly what this program is all about. It will include the nightly sessions, will include scanning, finding trades, discussing the trades, the setups, taking those trades, and of course, managing them. The trades will be called in this room and will be recorded and tracked in a tracking spreadsheet, which you should also have access to from your T3 Live account. Before we start the actual trading, I'll spend probably one full session going over the spreadsheet so you know how to use it, how to read it, and ultimately how to interpret the report it'll generate for us at the end of the 100 trade sample. So we'll be trading in 100 trades at a time, 100 trade sample at a time. Okay. And I'll explain all of that, why I'm doing this later. Okay. If you have problems logging into your account or accessing the material, please just contact T3 Live customer service. You should have already received an email from them with instructions on how to access everything. You can just reply to that email or you can call them at the number provided. And what else do I have to mention? Oh yeah, as I am currently broadcasting this live into this special room that we have, please feel free to ask questions at any time. Feel free to interrupt me at any time. I want to make sure that everyone understands the strategies that I'll be going over starting today. My only request is if you can, please just keep your questions relevant to the topic being discussed so that we're not jumping around too much. So if I'm talking about a certain strategy, ask me all the questions you want at any time. But if we haven't covered a certain strategy, wait, don't ask questions about that strategy yet. And that's it. Hope you enjoy the course and find it very beneficial. As I said, the program is really all about what's yet to come, what we'll be covering, what we'll be going through and covering after the course manual. The course manual is just going to be kind of an introduction to the strategies that I do, but the NGP program will be a hands-on experience, and the manual in no way really replaces it. So let me take any questions that you might have. Otherwise, I'm going to get started. But again, feel free to ask any questions, and we can get some of those questions now if you have any questions. We'll go for an hour each time, one full hour each session, Monday, Wednesday, Friday. Today being the first, I'm kind of excited. Any questions, let me know. Okay, if there are no questions, then we'll get started. Okay. So, okay. First, of course, a disclaimer to let you know that there is a very high degree of risk involved in trading. Make sure, always make sure you understand the risk, that you know what's at stake, basically. That's what you must make sure you understand. And that also the risk, what's at stake, is suitable to you in light of your own financial circumstances. A lot of the risk, honestly, can be mitigated through proper education and discipline on the part of the trader, but there are things, the risk is inherent in trading. There are situations where you really cannot mitigate the risk at all. And so just make sure you're aware of it. Of course, there is risk in any business, in anything that you do. I mean, walking down the street, you could, right? There's risk. Opening a store, there's a huge risk. You know, in trading is just like any other business. The issue with trading is that a lot of people dismiss the risk because they think, oh, this can't happen. It's not going to go against me. I know what I'm doing. No, anything can happen. So make sure you have rules and a trading plan in place to mitigate the risk. All right. And as I said, with proper education and discipline, you'll mitigate a lot of that risk. Okay, that's the disclaimer. Let's start. This is going to be part one. I'm not sure how many sessions it's going to take me to cover the entire manual. It's 200 pages long. I'm thinking a couple, maybe. Allen Day. Oh boy. Should I be seeing or hearing anything? Most definitely. That's why I like, I want you to log in right on time at 1:30 so that we're not dealing with this later on. Um, so, okay. Um, Amber, if you're around, please, if you can get some of those questions, the tech support questions, that would be great. All right, so welcome to the Nightly Game Plan program. It's a hands-on learning experience introducing both general swing trading concepts and advanced strategies developed and tested over time. As a long-time trader of the Pristine method, I'm trying to find my cursor here, so let me just find it before I keep. Okay, there we are. As a long-term trader of the Pristine method, those concepts are the foundation for my strategies. However, this class will solely focus on the longer-term charts, swing trading and core trading. You'll learn advanced tactics, stock selection, trade and money management, as well as new ideas and strategies truly never taught before. Never taught before. This program is designed for the wide array of long-term traders or investors, including those who follow the market the entire day and those who only have about 30 minutes a day. That's fine too. Okay? Once you have an understanding of what is involved, you should always try to keep your trading simple. It does not have to be complicated. But to get to that understanding, we have a lot of material to cover. So let's begin. Table of contents. We have the introduction chapter, which we're going to cover right now. What is swing trading, general guidelines, difficulties and unique advantages, the four major trading timeframes for the swing trader. We have the foundation chapter. Is anybody having any issues with the sound? Any issues with the sound? No, no issues. Um, all right. So Basil can't hear me. Let's see. 1 second, please. 1 second. Okay. Okay. Um, I'm not sure what to do with Basil, so. He's going to have to listen to the recording. So, okay, again, the introduction, the foundation chapter, the only movement possible, basic unit strategies based on the basic unit, and then NGP swing trading strategies. These are the strategies that I will be using. And then we have a chapter on each strategy. The first strategy, which is the transition A, using a breakout, transition A using a buy setup. Second strategy being the transition B, the climactic sell setup. Third strategy is the transition C, which is basically the same as the first strategy, except this is on the short side. The fourth strategy is the transition D play. The fifth strategy is stage 2 and 4 plays using breakouts, breakdowns, buy setups, sell setups, 1, 2, 3 plays, failure patterns, W patterns, M patterns. I'll show you all of these as we go along every week, right? Every couple of days we have a session. And then the sixth strategy is the gap play. This is something I discovered probably I think in 2010. I might have not started trading it until 2011, but that's something I personally discovered on my own in 2010, late 2010. And then the seventh strategy, I also discovered this a long time ago, but I never really traded it until just recently. I mean, this last earnings season that we just went through last month was the first time that I've ever traded the earnings play. This is definitely the most exciting one by far. It's also the most dangerous one. I've figured out a way to mitigate a lot of the risk, and we'll talk about that later. Chapter 10 is about trade metrics. 11 is about scanning and stock selection, how to create your universe, how I scan, and how I created my own universe. Closing comments is chapter 12, and then a glossary with the definition of some of the terms used and adjectives used in the manual. Okay? All right. So, introduction to swing trading. So what is swing trading? Swing trading is an income producing or wealth building style of trading. It depends what account you put it in. And it also depends if you're a short-term swing trader, like just an overnight hold, 1 to 2 day hold, or more of a, sometimes swing trades turn into a 30-day hold. So if you focus on the 1 to 3 day holds, you're more of you'd be using swing trading to generate income. If you're focusing on the longer term wealth building swing trades, then you'd be said to be like a core trader, or you'd be focusing on wealth building. It is designed to capture short-term swings in an ongoing trend while sidestepping the brief counter-trend moves. It attempts to take advantage of an often overlooked niche, one that is too short for large institutions and too long for floor and day traders. Large institutions don't get into a position only to get out of it the next day. That rarely happens. Floor and day traders don't keep anything overnight, right? So it's a unique niche, so to speak, and that's swing trading. Positions are generally held from 1 to 10 days. As I said, sometimes I end up keeping the position for a month. Just like in day trading, the most important element about swing trading is deciding what style to pursue and patterns to focus on. Uh, People often overlook this. I mean, they pretend as though I didn't even mention it or say it at all. But the style and patterns you choose must suit you, be in line with your own natural personality, and make perfect sense to you. You might have heard of what's the name of the guy? Jack Schwager. Might have heard of the story he once told about how when he first went out, set about to interview the world's best traders, thinking that he was going to find the one thing they all had in common, the one strategy, the one thing they all traded, the one methodology they all traded. Um, so he can actually do the same thing, replicate it and trade it himself. only to find out that not a single one of them traded the same thing. None of them traded the same thing. Each and every one of them traded their own methodology. But what he found to be similar amongst all of them was that they all traded in a way that suited who they are, right? That made perfect sense to them. And that's a tough thing to figure out. How do you trade in a way that actually suits you as a trader? That's not easy. It often takes a lot of time, a lot of thinking, a lot of contemplation, so to speak. And but it's important because once you figure out what you naturally gravitate towards, what makes perfect sense to you, what you actually really love trading, then bam, you got it, right? You got it. You're not forcing anything anymore because it just comes to you naturally, right? Um, all right, since you are taking on overnight risk, it's paramount to take only high quality setups with secure stops. Sometimes I see traders looking at the 5-minute chart and say, what do you think about this as a swing trade? Well, maybe the daily has a good setup, sure, but I would never put my stop on base my stop on a 5-minute setup or even a 15, right? So you have to take setups that offer secure areas that the stock should not be able to uh, break or violate easily at all, right? So make sure that you pick your stops not necessarily based on what's tightest, but based on what's most secure. The market itself is a more important factor when swing trading than in any other style of trading. When playing swing trades from the hourly and the daily charts, make sure the weekly chart is in alignment or at least not conflicting. Sometimes I'm playing a swing trade off of the daily chart and it's long and it's right into a declining 20 on the weekly chart. That's not good. Yeah, that's not a very good idea. So you want to make sure at least the weekly is not conflicting. When playing core trades from the weekly chart, make sure the monthly time frame is in alignment, or if it isn't quite in an alignment, make sure at least it's not conflicting. As a rule, stop playing a trend when the larger time frame hits a conflicting area. Examples to follow but can include an uptrend on a smaller time frame running into a resistance area on the larger time frame. An uptrend on the smaller time frame running into a declining 20 or a downtrend line, or a general area of a pristine sell setup on the larger time frame. Lastly, make sure the company has no pending news announcements unless that's what you're actually playing, which is the earnings strategy. The earnings strategy gets you into the play the day before the earnings, right? Or the night before earnings. And we'll cover that at the end. Not today, but perhaps tomorrow or the day after. The market is by far difficulties. The market is by far the most difficult part about swing trading. Smooth and trending versus choppy and sideways. I don't mean just the market itself. I don't mean like, look at the cues. Is it choppy and sloppy or is it trending nicely? I just mean the market environment, right? I just mean the market environment. Is it conducive to swing trading or is it not, right? Sometimes market environments are great for swing trading, and sometimes they're just not good. And you look at the market sometimes and you say, wow, the market is moving up nicely. And yet you look at just the swing setups, nothing is going very much at all. Yeah, or setups are not quite right. Yeah, the patterns are not shaping up quite right. Of course, I'm going to show you all of this step by step. But I'm just telling you, the market environment is by far the most difficult part about swing trading. Overnight gaps can present difficulties from time to time, but it's rare if you are trading along the line of least resistance. Unexpected news can present a major obstacle, but it's extremely rare. Not only that, most of the gaps, if you're trading in the right direction, are going to be in your favor, not against you, right? Most of the time, the news is actually Again, the news goes along the line of least resistance. So if you know what you're doing, most of the time you're going to capture these gaps or these news announcements, unexpected news announcements. Share sizing and stop selection must incorporate inherent volatility of the underlying security. Sometimes I find stops that are, stocks with 10, 20-cent stops. But you look at the stock and you say, this stock gaps every day about $1 or $2. Can I reasonably use this 20-cent stop? No, you can't, because the stock, just by nature, is a wild stock or just a gappy stock. So you wanna be reasonable. I think being reasonable in trading is one of the single most important qualities to have. When I say reasonable, I mean just use common sense, please, right? We all have common sense, but we don't always use it, right? Especially in environments that we're not familiar with, such as trading. But really, common sense can be used, or your critical thinking can be used regardless of the environment you're in, because it's your own innate intelligence, so to speak. And as I've said before, your own innate intelligence is what puts you right at the gate to profitability, right? Right at the gate. And that's why you must trade in a way that suits your personality and that suits you, that makes perfect sense to you, that you actually really like, right? So that you're not forcing anything, so that things make perfect sense to you, right? Immediately. So we'll talk again. We'll talk about every little detail later. Um, okay, okay. So Amber is there to answer some of these tech questions. Guys, I asked you to interrupt me at any time you want, right? If it has to do with questions about what I'm covering. But if it's tech issues or, can you give us a printable version of this? Please email customer service so I don't interrupt the presentation so I can answer stuff like this. Yeah, just email customer service, give them a call, get in touch with Amber. But if you have questions about what I'm covering, feel free. All right? Hopefully that makes sense. Advantages. During trending markets, swing trading is the easiest style of trading and requires the least amount of dedicated time, least amount of effort, basically, right? Requires the least amount of effort. News announcements, as I said, work in your favor most of the time if you know what you're doing. Most of the work is done after the market's closed and maybe before the market open. I like to do it after the close rather than before the open, because before the open, I'm an active day trader, so I'm using my time to prepare for the day, right? Scanning for gaps, doing stuff like this. So I prefer to do the work after the close. Some people prefer to do the work before the open. That's fine too. Also, what I found is doing the work, the prep work before the open, will often, you'll see what the market is doing, and you might overreact to it. Whereas the night before, you know, you don't know what the market is going to be doing the next day. So you scan and look for plays objectively, and then you're not overreacting. The market is not moving. Pre-market it is. Your emotions might kick in, and you might start to overreact. And in the morning, you can just adjust, right? So I prefer to do the work after the close, and we'll be doing it together. And then pre-market, if need be, I'll adjust, meaning I'll cancel some plays. I'll, I'll activate some other ones. Does that make sense? Okay. Um, there's a large universe of stocks to select from and a multitude of strategies that are available to the swing trader. So that's another advantage, is that we have a large universe of stocks to select from. You don't have to play, the stocks don't have to be as liquid as when you're day trading. When you're day trading, you're trying to capture 10, 20, 30 cents, right? And then your stops are really tight and your position is probably, not that small. So you can't have too much spread, because then, if the stock is spready, let's say, and you have a 20-cent stop and the stock has 20-cent spread, your risk unit just doubled, right? Just got doubled. So in swing trading, we're looking for larger moves, bigger moves. So it's okay to, and we're not looking to get it in and out of them quickly. We're looking to let them play out for a little while. So it's okay to trade slightly more thin stocks. All right. So any questions on this? Let me know. Any questions? I'm just looking to see if there are any questions. If there aren't, okay. So Amber's answering some of your questions. Okay, the four major time frames. The monthly chart, each bar equals 1 month. This time frame is primarily used to set the bias for core plays and gain perspective of the long-term picture for the stock, right? So it's mostly for core plays and just really to get a perspective of what's happening with the stock on the longer term charts. This afternoon in the black room, we looked at the GLD, which is the tracking ETF for gold, and we looked at a number of gold stocks. What did I look at first? The monthly charts. So I showed you what's happening with the monthly chart, and then we drilled down to the weekly and the daily. Traders of a weekly chart setup should never take a trade without first consulting the monthly chart. If you're taking a play off of the weekly chart, you always want to consult the next higher time frame, the next time frame up. Similarly, if you're taking a trade off of the daily chart, you should always look at the weekly time frame. The weekly chart, each bar equals 1 week. This time frame is primarily used to set the bias for trades that originate from the daily chart. Daily chart setups should never violate a trend that exists on the weekly chart. This time frame can also be used for entries on longer term plays. The daily time frame, this time frame can be used to set the bias for short-term swing trades that originate from the hourly chart. However, it is primarily used to find swing setups. It's the main time frame. Basically, if you're looking at a swing setup, the first thing I'm going to ask you for, or the first thing we're going to look at, is the daily time frame. Is there a pattern on the daily chart? If there isn't, I'm moving on. I'm waiting for it to set up maybe. But that's the main time frame. It's like if you're if you trade the 5 minute chart and you take a play because it has a setup on the, let's say, the 1 minute chart, but the 5 minute has no setup at all, it wouldn't make any sense. So the daily time frame is the main primary time frame for swing trades. Traders of an hourly chart setup should never go against the daily time frame, with the only exception being the gap strategy, which obviously we'll go over when we get there, when we get to it. And then the last time frame would be the hourly chart. Each bar equals 60 minutes. This time frame is used for entries to strategies that originate on the daily chart. So the hourly time frame is mostly for entries, right? This is where I want to get in. This is the time frame that I want to use to get in on that daily buy setup or daily breakout. So that's the hourly time frame. The hourly chart is also the main time frame for trade management. Okay. So give you a summary. The weekly and especially the monthly are used to gain a perspective of the larger picture and for core or position trading. The daily time frame is used for finding patterns, and then the hourly is used for entries and management. It's pretty simple. Weekly and monthly are more for just looking at the larger picture and for long-term trading, if that's what you want to do. The daily is for finding the plays, and the hourly is for finessing or for perfecting your entry on the daily time frame by dropping to the smaller time frame. That's all you need to know. The foundation chapter, section 2. To understand swing trading, you must intimately know the only movement possible in the market. It's the only movement possible. A lot of you are familiar with this, but some of you, some of you think you know it, but you really don't. Now let's cover it and see what you think. Actually, if you want to know whether you know something or not, like especially in this case, just look at your trades and ask yourself, do they correspond well to this picture? Are they in agreement with this picture? See what I mean? Then you say, okay, I know it, and here's the evidence. But if you say, yeah, I know this four-stage cycle, and you look at your trades and you don't know where they fit, where they go, right? They're not. This is not quite a stage two play, but that's not a stage one. You don't know where they go. Then you don't know it. Yeah, makes sense. All right, this is the only complete movement a stock or market can make. There is no other movement possible. The entire life of a stock and or the market is comprised of this cycle repeated time and time again. This cycle forms the basis for one's ability to predict future price movements based on the laws of psychology and probability. This cycle, sometimes referred to as the basic unit, helps the trader know the current status of a stock or market, as well as what is likely to occur next. The key to trading successfully is knowing where you are in the cycle. The key to trading successfully is making sure your trades are in agreement with this cycle. This cycle is comprised of four distinct stages, which in turn are ruled by four distinct emotions. Stage one, right? Stage one is ruled or dominated by the feeling of ambivalence, or a slightly better word for ambivalence is indifference. People traders don't care about the stock. They really couldn't care less about the stock. So they're indifferent to it. They're oblivious to it, so to speak. They're not interested in shorting it. They're not interested in playing it long. Yeah. Um, Brenda, Mark posted AXL for long and short. Is that for this class? No, no, that was for the black room, Brenda. Okay, it was a day trade, not a swing trade. All right, so that's stage one. Stage two is dominated by the feeling of greed, right? People get really greedy, especially near the top, right? That's that's what stage two is dominated with, and or driven by, right? Greed, and everybody just wants to be in the market at any, at any cost. They just want to be in it, and that's why we say the greater fool theory works in stage two. A fool buying up here is late, that's way too late, but still will make money as long as there's another fool that's going to buy from him up above at a higher price. So we say the greater fool theory works in stage two. Stage three is a topping stage where the feeling of uncertainty dominates. Nobody's sure anymore. Bulls are not sure. Bears are not sure. There's no certainty. I mean, nobody's sure about the direction. Sometimes it depends. That's if it's a base. Sometimes it's very abrupt, where everybody is sure that the stock is going higher or the market is going higher, and then of course it ends up running out of demand. It ends up running out of buyers, and then you get an abrupt drop. That's when the stock goes climactic. But when it bases at the top for a long time, that's when there's a lot of uncertainty. Nobody's sure. So it depends on how stage three uh, sets up or forms. And then stage three breaks into stage four, which is dominated by fear, right? Most traders lose money in stage four. A lot of people think the market is a zero sum game. Everybody says that, by the way. Have you ever taken time to think about it? It's a zero sum game. So in stage four, do you think most people lose or make money in stage four? Anyone? What do you guys think? In stage four, most people lose. So if most people lose, then how is it a zero sum game, right? If most people lose, is money really flowing out of one person's account and going to another person's account? Is that what's going on? No, that's not what's going on. Yeah, now you got thinking about it, right? I got you thinking about it. No, most people actually lose money because stocks. So when people say the market is a zero-sum game, that's true, but it's also not true. It's not true because stocks are a stock or the market is an asset. If you own a stock, that's an asset, and assets can go up or down in value. So during stage fours, um, the asset is declining, right? It's dropping in value. The stock is declining, the asset is dropping in value. So most people lose money. Does that make sense? Uh, it is a negative sum game because of the commissions, yes. But it's actually even if there was no trading at all, right? If there was no trading at all, it would still be it would still not be a zero sum game because, like I said, there's an asset that's either gaining in price in value or dropping in value. So during stage four, it's not. I used to think when I first took the TPM class with Pristine 10 years ago, I used to think that, well, if it's a zero-sum game, it means that in a stage four downtrend, it means that money is coming out of some people's accounts and into other people's accounts, and that isn't true at all. Most people actually lose money in stage four. Yeah, just like in stage two, most people make money, right? And it's not coming out of somebody else's account. They're gaining money. They're making money because the value of the underlying security is appreciating. And then the cycle obviously um, repeats, right? We come back after stage four, we get stage one. And here's some charts for you just to look at. These are longer term charts, like, and then you can see them yourself. I mean, you don't have to look at the, I mean, you can see them on look at some of the biotech charts. Look at a lot of the biotech companies, how the charts look. I mean, just exactly like this, right? Exactly like this. Now we show you monthly charts because they show the full cycle. I'm trying to find my cursor here. Here it is. Stock going from 5 to 45 back to 5. Once the stock tops out, puts in a serious top like this, there's almost never a recovery. It doesn't recover. I mean, look at the ESPR. In next week, we'll start using live charts. So I'll show you live charts. But look at the ESPR, for example, right? It's the same exact thing. Again, from $10 to 100 back to 10, right? And once the stock tops out, puts in a serious top, there's really no recovery almost for a very, very long time. A lot of stocks just go out of business. I know of family members that own stocks at $200 and $250 per share. The price of the stock was, and it went down to 1 penny or 2 cents or zero in some instances. So there, and then sometimes they go down to 5 or to 3 or to 2. That's almost as bad as going to zero. A question: if there's only two traders, it would be a zero sum. No, it wouldn't be. So it's because more people are investing daily, so the flow of money is positive, and the converse in stage four. No, that's what I'm saying is that even if there were only two traders, it wouldn't be a zero sum game because um, uh, now if there were equal, if for every long trader there was a short trader, for every uh, outstanding share, there was also the inverse of it, meaning the company issues 100 shares and then the company also issues 100 short shares, so to speak, an inverse, then yes, it would be totally a zero sum game. But remember, the company doesn't issue that when the company goes public, they issue, let's say, 1 billion shares. Those billion shares have value, right? Each share has, and that's the price. So when the market drops or when the stock drops, that asset, that stock is dropping in value. And that $1 billion, let's say, if it's a big company, let's just say, and it was worth $1 billion, and then the stock goes out of business, it means $1 billion was lost. $1 billion was lost. So it's, so you can't say it's a zero-sum game because $1 billion just basically vanished, right? Does that make sense? All right. Um, at the transactional level, the market is a negative sum game, right? Because there's commissions and all kinds of things. All right. All right. Let's continue. Take a look at some more charts. Notice that sometimes, um, it's just a run up, and one top does it, right? Just one. That's the deadly doji. One. This is my favorite reversal bar of all time. It's actually the narrow body bar, the narrow body. But sometimes it doesn't, it takes a couple of, like, it takes a retest and failure. So here's the first top, and then the stock goes way back up and then fails. That's even worse because the stock actually attempted to go higher, sucked in the last batch of buyers, and then it failed, right? And then notice again, the same idea there, same exact thing, same exact thing. And this one made a higher low. So this was a good climactic sell setup. Didn't work the second time around. That's what I call the second time around. If the first one didn't do it, the second time around typically does it. The key thing is that the first one has to be good. If it's good and the stock failed on it, then the second time, once it sets up, it's good. And that's a monthly chart. Now you can look at daily timeframes, which show you the same exact cycle, but not as not as dramatic. Going forward from this point onward, always assume the following: red line is the 200 MA, blue is the 20, and if you see a black line, it's the 8. I typically don't use the black line, but sometimes some of the charts I took a picture of, I had unfortunately the 8 MA on. So 20, the red is the 200, all simple. Blue is 20 and black is 8 MA. And again, that's the daily, showing you the four, at least 3 of the 4 stages: the uptrend, the stage 3, and then stage 4. Yeah, nice wide bases. Notice that near the bottom, big sell-offs or big bars, big volume there, have produced no follow-through to the downside. Yeah, produce no follow-through, and then the moving average starts to go through prices and eventually captures the stock. So on this one, there was an entry right here, but it was hard because it was under the moving average. That's not easy. That's a better entry. Yeah, that was a better entry. That's a better entry too. Breakout. So this is also, notice the breakout failure there. Big green bar met by a big red bar, and then the stock bases, and then finally the moving average captures the stock, halts it, so to speak, from continuing higher and starts to point down. That's stage or transition C, stage 3, and then bam, big drop. Okay, question for you. What areas, in your opinion, likely provide the best opportunities with the highest reward to risk? What areas on, let's say, on this cycle? We're on page 30 on this cycle. 2 and 4, 2, greed and fear. Okay. Anyone else? Feel free to participate, guys. This is, okay. Feel free. This is going to be, we're going to be talking a lot to each other. 2 and 4. The best areas are, let's go ahead and take a look at the same cycle here, but we'll look at it marked up. How about we mark it up like so? See this? This one, I marked it up. It's the same cycle showing you what's available to you to trade. So it's showing you all the strategies that are available to you as a pristine trained trader. The picture you see to the right could very well be the most important picture you ever see. Going over it won't take me more than a few minutes. Grasping it might take you 10 years, 10 months, 10 days, or even just 10 minutes. It all depends on how ready you are, where you are in your evolution as a trader or understanding as a trader. However, once you do, your trading will never be the same. That's a promise. And that's the truth. I've heard from traders that said, remember when you went over this with me 2 years ago? I thought I really understood it. And it was last week that it dawned on me that I didn't, and now I think I got it. See what I mean? I've heard from traders just like that. So stage one, what's available to you to do as a trader? What strategies? What setups? The buy setup at the bottom. So a buy setup at major support or a sell setup at major resistance. Short the bottom, buy the bottom, short the top. That's stage one. And that I don't do. It's very, very hard to do. Why? Because there's no trend underway. So you can buy at support, but support is often not just a straight line like this. It's all over the place. And there's no trend. So you can't even use the hourly chart very well because the stock is not trending. So I don't do this. You don't have to do everything that you know about or that you know, right? Every strategy that you know, you don't have to trade everything. And then we have stage two. No, before we have stage two, the stock will have transitioned, right, from stage one to stage two. So there's the transition A breakout. So again, there's stage one. Let's see, I can erase, right? Can I erase? Look at that. No, I can't. Can I erase this? Oh yeah, that's pretty nice. So there's stage one. Yeah. There's also you buy at the bottom, sell at the top. There's the transition A breakout or buy setup, depending on how the stock sets up. And then once the stock transitions into stage two, then you can do the bullish patterns long, such as the buy setup at minor support rather than at major support. The bullish pause that refreshes breakout, this breakout is not the same as the breakout at the bottom. The breakout at the bottom is called the core breakout or the position breakout basically. This one is called the pause that refreshes because the stock is already in an uptrend and a pause just gives it a breather, gives it a break, and it refreshes the trend, so to speak. So you can do the pullback, you can do the buy setup, you can do a 1, 2, 3 pattern, you can do a W pattern, you can do a failure pattern. Any setup applies as long as you're playing long, not short, right? And as long as the setup meets the pattern requirements. Each pattern has some requirements, and as long as the setup meets those requirements. Then transition B is when the stock goes climactic. Sometimes the stock doesn't go climactic at all. It just casually kind of tops out by going sideways and then breaks down. So sometimes the stock will do this, will go way up, climactic. Sometimes it'll just go up and then just kind of casually roll over, whichever way it sets up. If it gives you a climactic sell setup, that's called transition B. If it doesn't, then you can't really do it here. There's no way to predict. There was no way to know that this was the top. So what you look for is the breakdown, transition C. So it depends. And sometimes, as you saw on those monthly charts, you get the retest and failure, like so. Does that make sense? You get the M pattern, basically. You get the M pattern. So it depends on how the stock sets up. There's no way to know, right? And then stage three, let's see here. How do I get rid of all of this? Okay, that was easy. Good. And then we get stage three, which is the same as stage one. You short the top, buy the bottom. transition C, you do the transition breakdown, pristine breakdown. And then stage 4 is the same as stage 2, except stocks are dropping at probably 2 to 3 times the rate. Did you know that, by the way? That bullish markets take on average between 5 to 7 years. The current bullish market that we're in is the longest in the history of this country, in history. Is the longest in history. But so it's exceeding the norm. Normally, bullish markets last between 5 to 7 years. Bearish markets last between 1 to 3. That's it. 1 to 3. Probably on average, probably more on average 1.5 years. I mean, if you think about the devastating bearish market we experienced in 2008, well, started very late 2007, November, let's say 2007. Did you know we bottomed on March 9th of 2009? So it only lasted a year and 4 months maybe. So during stage 4, while it's technically speaking the same as stage 2, stocks are dropping really hard. So it's not, so it's not as easy to catch them. If you miss the entry, you're going to be left behind in the dust, so to speak. You're just going to be left behind, and the stock will drop really, really fast. So that's the characteristic of fear. And as fear turns into panic, then the stock goes climactic again, right? And those that came in late, bought the stock maybe up here, typically are the ones that exit late. Why? Does anybody know why? Think about it from a psychology point of view. Psychologically, why? The ones that come in late typically exit late also. So hoping, but why? Why is it you never let somebody get away with something, an instructor like myself, without challenging them or making sure you understand what they're saying? It's because the ones that came in late, they only came in because they couldn't stand the pain of not being in the market anymore. They just couldn't take it anymore, of missing out. So they finally said, screw it, I'm in. I'm getting in. So they needed a lot of convincing, a lot of confidence before they were willing to risk their money. And when they're wrong, they also want to be 100% sure they're wrong before they get out. Does that make sense? And those make for the worst traders possible. The worst traders are the ones that wait until they're 100% sure that that the stock is higher before getting in it, which means it's too late, right? If you only waited for the ones that you were 1,000% sure about that the stock is higher, it means it's too late. Most of the time it means it's too late, but it's always late to wait. I mean, if you wait until you're really sure that you were wrong to get out, you want to get out at the moment that you sense, that you feel you're wrong. You don't want to wait. What's the name of the game? What's the name of the business we're all in? It's called speculation. It's not called wait until you're 100% sure before you get in or get out of something. And most people miss that point. This is not a game of certainty. You don't get into or out of a position because you're 100% sure, especially when you're getting out of something. And by the way, that's exactly what leads to what creates tops, climactic tops, is the reason why the stock goes climactic like this, when they do, is because traders become incredibly convinced, 100% sure that the stock is higher. When you're convinced that the stock is higher, that this is the next Apple, the next Google, what do? You just jump in. You don't care anymore. You just get in. This is going to the moon. So when they're 100% convinced, that's when the stock actually goes climactic, right? If they're not very sure, they don't just jump in. They wait for a pullback, right? They don't chase it too much. They wait, and that's what creates this kind of a trend, right? That's what creates this kind of a trend. Because the ones that are not so sure, they always get out once the stock starts to go against them or the market. And then the stock pulls back, and then it goes back up, and then they become unsure again. They want to take their profit. They don't want to give back their money. But when they're 100% convinced that they're not going to be giving back their money because this is going to the moon, then nobody gets out, and they just buy, and then finally the stock runs out of demand. There's a limited number of buyers that are available at any given time, right? And so the stock reaches a point where there's no more sellers, no more buyers, and then it just falls apart. Yeah, when it drops, it just drops. It gets sucked into a vacuum, so to speak, and that's what creates climactic tops. All right, so good stuff. Okay, let's continue. And then again, stage 4 is similar to stage 2. It's the same idea, but except that here we would be shorting rather than playing long. Transition D is the same as transition B. Transition C is the same as transition A, but they set up differently. So again, they're in theory the same, but they set up differently. And stage 1 is the same as stage 4, right? And then the cycle repeats. The most compelling areas, the best areas that offer the highest reward to risk are the transition stages. Transition A, B, depending on how it sets up, sometimes there is no B, it's just C. So the transitional phases are the areas that offer the highest reward to risk the chart will ever see, right? Because remember, I asked you in the previous on the previous slide, what areas likely provide the best opportunities with the highest reward to risk. So that's the answer. Okay. All right. So strategies solely based on the basic unit, on the picture that we were just covering right here. We were talking about. Here they are. Stage 1 and 3 plays, and I don't trade these. Buying at major support, selling at major resistance, right? Buying at the bottom, selling at the top. Buying at the bottom, I don't do that. I need a trend, I need fluidity, I need movement. I don't like to play sloppiness and bases. So I don't do that. Transition A and C, so for A it would be the breakout, or sometimes you don't get a breakout. So stocks will go, the way transition A works is, let's see if we can have a slide that has more space, blank space, I mean. Transition A through a breakout is when the stock, comes in, bases, and breaks out. Pretend that this is the 20 MA, and then curls from underneath, and it breaks out off of the moving average, right? But sometimes what happens is the stock doesn't set up like this. It actually, it's downtrending like this, right? Moving averages on the other side above it, but the stock doesn't base, it just rallies really hard. And then pulls back to the curling moving average, to the newly rising moving average. And that you can also call transition A. It's the transition the first pullback or the transition pullback, right? So transition A can happen through either a breakout, as I showed you, or through a pullback, whichever way the stock sets up in, right? With transition C is the same thing, except on the to the short side, to the downside. Having said that, most transition C plays, most transition C setups happen through a 1, 2, 3 pattern. Don't know why. Don't even ask me. I have no idea why. Most transition C plays are 1, 2, 3 shorts. A bearish 1, 2, 3, 1, 2, 3, 4. I'll show you plenty of chart examples and you'll see for yourself. But that's transition C. So it's not exactly the same as transition A. All right. Stage 2 and stage 4 plays, the buy setup at minor support, or the pause that refreshes, the breakout, or the 1, 2, 3. That's fine. Any pattern will do as long as it's in the direction of the trend, if it's an uptrend or a downtrend. And then transition B, and D, those are the climactics, climactic buy setup, climactic sell setup. Sometimes you can also do the retest and failure, so the stock goes climactic. You don't get the top, or the top doesn't give you a good entry. You can look for the retest and failure right here. Okay, so it depends. And then also stocks go climactic to the downside, so you can do it long too, right? So I do this, and that's my favorite. This is my second favorite. And the transition B and D is not that it's my least favorite. It's just that stocks rarely set up with, they rarely put in a really nice transition B or D setups. So I end up passing on most of them. Additional strategies, which I personally discovered, in addition to the previous strategies, I've also discovered the two following strategies. One is the gap strategy. And there's two types, right, of gaps: igniting the move, and ending the move type of gap, igniting and exhaustion gaps. So the gap strategy, and then the one that I just started trading recently is the earnings strategy, which requires entering into positions the day before they report earnings, right? The day before, just like Lulu the other day, I was in it short. Yeah, you can use options, of course, if you want. Yeah, there are advantages and disadvantages to using options to get into earning plays or swing trades in general. So again, the strategies that I do are 1, 2, 3, 4, and 5. Now you can do long and short, of course, right? Long and short, so almost 10, but really they're 5. Any questions about what we covered tonight at all? Let me know. Any questions? Okay, because if there are no questions, we are done for tonight. This is just the first session. We'll be back on Wednesday. So clear as, hopefully, I was going to say clear as mud, but hopefully not. Hopefully it was really clear what I covered so far. Okay, great. No questions. Wow, that's awesome. That's great. All right, guys. Thanks for being here tonight. I will see you. Okay, here's some questions. Be prepared for the questions, so that I don't have to, ask you. Feel free to, just jump in before I. And when you say the day before earnings, could it be the same day? Yes, if it's reporting after the close, it could be the same day. I just meant, yeah, it could be the day before. The same day. That's right. And then, are there any swing setups to watch? There are, but I don't want to call anything official until we've covered all the strategies. I've covered a few. I mentioned a few tonight in the black room, but I won't be calling them in here until we've covered the manual. There's the AEM that I mentioned as a core idea, CPB as a short, right? Swing though, that's not core. There's also the AFC, swing short is not bad. This is just off the top of my mind. What else is there? There's the Finel as a short under $14. That's a sell setup, setting up. It hasn't triggered yet. And then there's my favorite, which is the Massey. I'm going to do it tomorrow under 92.70. But again, I'm just telling you what's setting up right now because you asked. I don't even have my charts up. Hun already gone. I didn't take it and it triggered. So there's the Matthew, which I am going to do 92.70, or I'll give it to probably 60, 50. Give it some room. I don't want to get sucked in by a penny or two. It's a wild stock with a stop over 95. So about 92.50 by 95. So there are some ideas. I just mentioned a few really off the top of my mind. I'm not even looking at charts. The spreadsheet is okay. That's Andre Amber answering your question. I'll talk about the spreadsheet after we've already covered the course manual. Does that sound good? Because why would I want to interrupt the course manual to talk about the spreadsheet? So we'll talk about the course, the spreadsheet. We'll go through the spreadsheet once we finish with the course manual. Okay, and then that's where I'll be posting trades. Of course, J&J, feel free. How do you handle a bad gap against you? Yes, there's going to be, I'm going to teach you how to do it, or I'm going to share with you how I do it. Okay, when you have a gap against you, I'm going to show you exactly what to do. All right. So I'll show you that later. We'll talk about that later. Okay, the previous question. Do you change your management to incorporate the new info? Okay, in the gap strategy, the ending move could be considered as stage 4. Yes, it can be, and transition D. That's right. If you're playing the, if you're playing the exhaustion gap, you can say that's the bottom. Right. Exactly right. You can. Exactly right. Hey Keith, glad to be back. Glad to have you. And I'll see you in the room soon. That's great. In the black room. That's awesome. Okay. All right. All right, guys. Thanks again for being here. One last question. Is it hard to go from being a bear to a bull? No, I don't think it's hard at all. I don't think it is at all. I just, personally, I don't think it is. Yeah. You have issues with that. Yeah, probably. I mean, initially maybe it was, but not right now for me. Probably initially. Yeah. All right, guys. Thanks again for being here. I appreciate the questions and the participation. I want to make sure that we're all on the same page. So if you do have questions, make sure to ask them while I'm giving the presentation. I'm happy to respond through an email, of course, but that takes more time, and then not everybody can hear my answer. So feel free to always ask during the presentation. Have a great evening, and I'll see you all in here on Wednesday. All right, on Wednesday. For those that are in the black room, I'll see you in the black room tomorrow. Good night, everybody.